Benjamin Graham, a renowned economist, professor, and investor, left an indelible mark on finance with his seminal work, The Intelligent Investor. First published in 1949, this masterpiece, which has seen numerous editions and updates over the years, serves as a beacon for investors seeking to navigate the tumultuous waters of the stock market. Among the countless individuals influenced by Graham's wisdom is none other than the legendary investor Warren Buffett, who often credits the Intelligent Investor as a cornerstone for his investment philosophy. Although born in the UK, Graham spent the majority of his life in the US, where his impact on modern value investing was profound. His tenure on Wall Street during the 1910s laid the groundwork for his later contributions as a professor of finance and security analysis at Columbia Business School. His 1934 publication, Security Analysis, is revered as a definitive guide to value investing, earning Graham widespread acclaim for his insights and expertise. Now that you're acquainted with Graham's legacy, let's unravel the essence of value investing itself. My name is Varun Dugirala and welcome to Finance Flashback, sponsored by ICICI Prudential Mutual Fund. Here, we dive deep into the intricacies of finance, simplifying complex concepts to empower you in your investment journey. By drawing insights from history, we decipher valuable lessons that can be applied to your present investment strategy. So let's embark on this enlightening journey together. Let's dive into a tale we're all acquainted with: Apple. While they say an apple a day keeps the doctor away, during the 1990s, investors were keeping Apple stock at arm's length for an entirely different reason. Amidst the tech stock boom of that era, Apple found itself struggling to stay afloat. With its stock price plummeting to rock bottom levels, many investors steered clear of the once promising company, fearing its imminent irrelevance. Facing a lot of challenges, including declining market share, product setbacks, and financial woes, Apple was on the brink of bankruptcy. Ever since the departure of co-founder Steve Jobs, there was a shadow of uncertainty over its future. However, despite the gloom, the spark of potential never dimmed within the company. In 1997, a pivotal moment arrived with Jobs' return, signaling a renewed commitment to innovation and design. This resurgence paved the way for Apple to unveil groundbreaking products that not only rejuvenated the company, but also revolutionized entire industries. One anecdote that encapsulates this transformation is the story of Anton Marinovich. Upon turning 18 in the late 90s, he received $1,000 from his grandmother for investment in stocks. Opting for Apple, Marinovich's decision bore fruit in the ensuing years. By 2012, his initial investment had grown to over $240,000, complemented by quarterly dividends exceeding $1,000, a testament to Apple's remarkable resurgence and enduring allure. This narrative also underscores a crucial lesson in value investing. Despite Apple's apparent struggles and low stock prices in the late 90s, astute investors like Marinovich recognized the intrinsic value of the company's brand, technology, and potential for future growth. By investing in undervalued stocks with strong fundamentals and long-term potential value, investors can capitalize on market mispricing and unlock substantial returns over time. Thus, the story of Apple serves as a compelling example of the rewards that await those who possess the foresight and patience to adhere to the principles of value investing. Another iconic company that weathered a storm of challenges was Coca-Cola. In the early 1980s, Coca-Cola faced increased competition and a declining stock price. However, some investors looked at the strengths of the company and saw that it had a strong brand, steady earnings, and a history of paying dividends. The plummeting stock price provided these investors with a safety margin, emphasizing the importance of purchasing stocks for less than their intrinsic value. Investors, including Berkshire Hathaway, adopted a long-term perspective, confident in Coca-Cola's resilience and potential for future growth. Those who seized the opportunity to invest in Coca-Cola when its stock price was low reaped significant returns as the stock price rebounded in subsequent years. This principle of value investing extends beyond stocks and can be applied to various aspects of life, including investing in people. Remarkable stories abound of how individuals like supermodels were discovered in unexpected places, like malls and vet clinics, to even like horseback rides. Just as astute investors recognize the hidden value in undervalued stocks, Those with a keen insight can uncover extraordinary potential in unexpected circumstances. We've explored the stories of companies and individuals, but the concept of value investing also resonates profoundly in the realm of land. Whether you are a farmer in Gurugram or Christopher Columbus embarking on his historic voyage centuries ago, the principles remain relevant. In 1492, Christopher Columbus charted a course that would lead Spain to discover America. This monumental expedition mirrors the essence of a value investing strategy, wherein a nation seeks and invests in assets that are undervalued yet possess immense long-term potential. Much like evaluating the fundamentals of a stock, Spain scrutinized the inherent value of unexplored territories, recognizing the opportunity for new trade routes, untapped resources, and strategic advantages. The decision to embark on this voyage was similar to the meticulous approach of value investors, who incorporate a margin of safety by carefully planning for the unknown, along with the attendant risks and uncertainties. Spain's steadfast commitment to a long-term perspective resonates with the fundamental philosophy of value investing, which aims to cultivate enduring economic and strategic advantages. These profound effects parallel the objectives pursued by value investors when they invest in undervalued assets, strategically managing risks and aspiring for sustained long-term growth. The study of history serves as a compelling metaphor for the application of value investing principles on a grand scale, illuminating the transformative potential inherent in prudent investment decisions. You can harness the power of value investing in your portfolio as well by investing in value funds. These are a category of mutual funds managed by seasoned professionals who employ a strategy aimed at acquiring stocks or other securities deemed to be undervalued relative to their intrinsic worth. The overarching objective is to foster long-term capital appreciation by identifying opportunities where the market price of a security fails to accurately reflect its true underlying value. Moreover, it's worth noting that mutual funds inherently offer diversification benefits by holding a diverse array of stocks spanning various industries and sectors based on the scheme's objective. As you navigate investments, remember Graham's wisdom and the power of value investing to guide you towards financial success. And with that, I'm Varun Dugirala, signing off from today's episode of Finance Flashback brought to you by ICICI Prudential Mutual Fund. We hope this episode was of some value to you, so don't forget to tune in next time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.